Hello, everybody. Welcome to Self-Directed IRA Saturday. My name is Zach Wilson. I'm an IRA specialist here at Quest. Thank you for joining us. So before we get started, got to give the disclaimer. Everything that you're about to see today is for your educational purposes only. All right. We want to be sure that we're providing the most updated and the most thorough education that we can to our clients and investors. With that being said, Quest does not offer any tax, legal, or investment advice. All right. So for those of you who don't know us, let me give a little bit of an introduction. Quest is the largest self-directed IRA custodian in the state of Texas with about 20,000 active investors all around the country. All right, as it stands right now, we have about $2 billion under assets in assets under administration and about over 100 employees, 34 of which are certified IRA services professionals. All right, now, as it stands today, we have about $400 million in undirected cash, right? What that means is opportunity, right? Whether you're an investor or a current Quest client, this is where your opportunity lies to make sure your deals get funded, all right? Now, before you start making any investments, the first step is to educate yourself, all right? Check out our YouTube, check out our website. You'll see tons and tons of videos, right? Ranging from the basics of self-directed IRA all the way to investing in multifamily deals like we're going to talk about today. All right. Now, once you've found that investment, well, now the networking starts. Right. Check out our weekly live classes on Tuesdays. Come to our self-directed IRA Saturdays like today. On the fourth Wednesday of every month, we have virtual happy hours that is strictly dedicated to networking and meeting other Quest clients who are interested in making deals. All right. By far, our most common and our most popular networking event is going to be our self-directed IRA Tuesdays. All right, those are our socials on the first, second, and third Tuesday of every month in Houston, Austin, and Dallas, respectively. All right, they start at 6:30, and this is every month. Now, once you have found that deal, the next thing we can offer you is our Quest Expo. Guys, this is the highest value we can offer you as a company, right? There's going to be tons of speakers, tons of networking is going to be there. Or we're going to go over private money lending, investing into multifamily deals, doing fix and flips in your IRA. Guys, this is everything we can offer to you as a company for our investors. Now, if you give us a call, not only can we offer you a discount on these expo tickets, but we can also give you a free account right now. You guys, before tax filing deadline, give us a call. Right now, we're offering free openings. All right. Get in touch with any one of our IRA specialists, and we'd be able to help you out with that. All right. So this is my contact information. If you want to give us a call, it's 855-FUN-IRAs. Check us out. Ask us questions. Even if you're not wanting to open up an account now, we'd love to sit down with you just to see what it's like to invest within an IRA. All right, so without further ado, to talk about investing into multifamily deals is Jonathan Richter. Jonathan, you there?
You guys so much for having me. Can y'all hear me okay?
Yes, we can. Yes, we can.
All right, perfect. Well, I'm very grateful to be here. Again, want to give the disclaimer very similar that, I'm going to show you guys a little bit about Rockstar Capital and the multifamily product that we do, and maybe a couple examples of people who have invested with us through Quest IRAs, actually. But I'm not giving any financial advice. Everybody's situation is different, so always highly recommend that you go to an expert to figure out what's going to work best for you. But hopefully we can show you a little bit more of what's possible today through the presentation I'm about to go through. But very grateful to be here. Thank you guys so much for sharing the platform.
Absolutely. Yeah, we're happy to have you. Without further ado, I'll let you take it away.
Okay, awesome. So the main gist of what I'm going to be talking about today is why Class A multifamily product is the future of what Rockstar Capital is buying and why it should be what you're investing in also. For those of you who don't know me, my name is Jonathan Richter. I'm the Investor Relations and Education Manager at Rockstar Capital. And so if you guys decide to invest with us in the future, you'd be contacting me and my team, Ryan and Kirsten and Jason. So I'll kind of go through a little bit of background just on Rockstar Capital in general. Normally on things like this, you'd be seeing our CEO, Robert, speak. I'm getting to fill in and wear the big boy pants today. But he has the distinction of being the first and only two-time National Independent Owner of the Year. He's also been featured in Forbes, Money, Entrepreneur, and CNBC. As a whole, Rockstar Capital has accomplished 14 cash out refinance events, which I'll kind of explain more on what that means in a little bit. And we also have the distinction of winning 19 city, state, and national apartment association awards in the 11 years that we've been in business. And that's an industry leading number. But Robert's been in the business since 2007. He worked on a couple of different projects before founding Rockstar Capital himself in 2011. Like I mentioned, we've been around for about 11 years now, and our current portfolio consists of about 22 properties that are a little bit over 4,000 units. So we're still rocking and rolling. It's been a very acquisition heavy year for us, but we have some kind of new things on the horizon that I'll tell you about. This kind of just shows you our company organization, so to speak. It's not just Robert or myself. At Rockstar, we both own and operate our deals. So when we buy an apartment complex, we don't send it off to boarding school and third party manage it with somebody else who's in charge of making it perform. We have everybody from in-house digital marketing to our leasing agents, maintenance professionals, our HR is in-house. We have asset managers that are reviewing the numbers of each property every day. And so we're kind of a one-stop shop for multifamily investing because we have direct control over all aspects of the deal. Going over to a couple of things that we're proud about. I mentioned those 19 city, state, and national apartment association awards. We've also been on HBJ's Fast 100 list the last 4 years. Probably what we're most proud of is that we've had 5 straight years ranked in Jay Turner's Elite 1% for resident satisfaction. That means that of all the properties that are polled within the United States of America, we have properties, at least 2 for the last 5 years, that have ranked in the top 1%. Meaning that we're doing a really good job of taking care of our residents, but we also show that we're maximizing our numbers. And so we find a really good synergy between that that we're really excited about. And then more exciting, you can kind of see our timeline for all of those 14 cash out refinance events that we have done so far. So far, as far as lifetime numbers, we've raised over $136 million in investor equity. We've returned $112 million back to investors. 50 million of that came last year. That was a record year for us where we were able to start taking more and more of our deals full life cycle now that we've been around for about 11 years or so. Our total assets under management is just over 600 million right now. And then kind of how the last 12 months have been for us. Like I mentioned, it's been very acquisition heavy. We've acquired 7 different deals and we performed a refinance. The total transaction volume on that was about 184 million. We've done 5 dispositions that sold for a collective 85 million. And then, like I mentioned, our new portfolio valuation is just over 600 million. And then this is what we're really excited about. In the next probably 6 to 12 months, we're going to be selling a portfolio of our deals, 5 different deals to be exact. And this right here on screen is the expected equity multiple for each of those deals. And essentially what an equity multiple is, for those of you who maybe aren't acclimated, is it's whatever you put into the deal, that's what the deal multiplied it by. So if you had put $100,000 into Water Chase, for example, that's about a 9.7x equity multiple, that has crazy outperformed our expectations. That means that your 100,000 would now be worth relatively, or something along the lines of 970,000. So we're really proud of the portfolio performance that we've been able to do with these deals. That's going to be sending about $53 million back to our investors' pockets that hopefully they'll reinvest with us. And that's kind of the glory of a self-directed IRA, is taking control of the investment funds that you have, getting to take agency and choose where you're going to place that and keep that snowball effect running. I'll kind of show you a little bit more on what I mean with that in just a second. So a few things that I want to share. You might say, oh man, you guys have bought 7 deals in the last 12 months. That seems kind of excessive. And we get feedback from investors all the time asking us if we think that we're moving too fast. But we're buying really aggressively right now, especially within the Class A space. And there's a couple of reasons for that. The first one is that there's massive migration to Texas. I think if you're paying attention at all in the real estate space, that should come as no surprise to you. But in 2021, Texas actually surpassed Brazil to become the 9th largest economy by GDP in the world. There is a lot of money flooding in here from California. In fact, we have the highest retention of any state. About 82% of people who are born in Texas still live here, and about 3,800 more people move into Texas than leave every single week. About 42% of that net migration also comes from California, which should come as no surprise to you. The other thing is rents are really exploding, especially in the Houston market. According to apartment data, Houston saw an average 12.8%, and that's an average across the entire city. So even the submarkets with low rent growth that would normally bring that average down, we're still seeing double digit. That's the first time that we've seen that in the years that we've been in business in Houston. Other cities like Dallas and Austin and San Antonio, they've all been on pretty skyrocketing rent growth paths for the last 10 years or so. Houston's been more of an up and down in terms of rent growth. We have gone through our fair share of struggles, whether it's hurricanes, record-setting freezes, COVID, things of that nature that have, especially oil and gas crashes. But we kind of feel like Houston's finally poised to start. It's kind of our time, I guess, is the gist of what I'm trying to say there. Also, submarkets that we're buying in, like I'll show you a deal a little bit later that we actually just finished raising equity for. Those submarkets are experiencing, as high as 23% rent growth, which is those are monster increases. Typically when we're underwriting a deal to stay conservative, we'll project out anywhere from 6 to 3% rent growth. Now we're moving those projections closer to 8 or 4, still staying conservative, but we're buying in some markets where we're not only seeing double-digit rent growth, but it's within the 20% range. And then, of course, everybody kind of knows, too, that housing habits are changing. They joke about how millennials don't want to buy houses, but houses are also so expensive right now that a lot of people can't afford that. And so people are opting to rent instead of own. Major builder companies are actually starting to build entire subdivisions that aren't meant to be sold. They're going to be built for the purpose of renting them out to people. And so renting is becoming much more common. The other thing, and this is kind of the negative, is that purchasing power is decreasing significantly because of inflation right now. That's kind of the hot button word that everybody's using. It makes a great case for why you should be investing your money, whether that's with Rockstar and multifamily or with a single family flip like he was just talking about. But consumer prices have jumped over 7% in the last 12 months. And 4 out of every 10 US dollars that exist today didn't exist 18 months ago. So that means that we've been printing money at an alarming rate, and that's driving both inflation up, but also the value of your dollar down. That, if our minimum investment at Rockstar is typically $100,000, people investing that with us, their purchasing power has gone down by, roughly 40%, 40,000. And so we really feel that in order to outpace the rate at which money is being printed, in order to outpace inflation, the best way to do that is through investing in real estate. And so that's why we get really excited about what we do at Rockstar. There's also, stock market volatility. That's why I personally like real estate a lot more, is its actual tangible bricks and sticks that has a valuation and also a history and a track record of appreciating over time. It's historically a much more stable and consistent investment opportunity versus, the stock market, where if somebody wakes up in a bad mood halfway across the world and decides to do the wrong thing, then the entire market can tank because people get scared. Or you see examples of clear manipulation like the GameStop short that, just kind of show you it's not a game that you're in control of. But if you're able to find someone who's flipping houses or investing in multifamily, who can be the lead on a deal that you can invest in, who you trust and you can vet, that person has direct control over the performance on the deal. There's always, extenuating circumstances. If a deal that you invest in gets hit by an asteroid, you can't necessarily control that. But I've yet to hear about a deal like that. It's something that's much more consistent, and you don't have to worry about all of that volatility. The other thing that we kind of talk about at Rockstar a lot is COVID changed the way that we look and buy at our deals. Typically, our bread and butter pre-COVID was Class Bs and Cs, which is essentially, product built in the 90s or earlier. Anywhere from 70s to 90s is typically what we looked at, because that was where there's a lot of value add opportunity where we can go in and do a significant physical renovation at a property and make our investors money that way. What we saw happen, though, whenever COVID hit, is that our residents were in a income class that was hit the hardest. We actually had to start knocking on doors trying to collect rent, work with our residents to be able to tell them about different rent relief programs that were out there, get them on payment plans. We saw a lot of delinquency at our properties, some of which was for very good reasons because there were a lot of people who were struggling financially throughout COVID. We also had a lot of residents who saw the eviction moratorium and said, well, that tells me that I don't have to pay rent, and so I'm not going to. And so we had to start using some of the tools within our arsenal to be able to collect that rent from people who were just refusing to pay as well. In our Class A product that we own, the newer construction with a higher rents, a more affluent tenant base, we saw almost zero delinquency. Some of our properties saw absolutely zero delinquency. We didn't have a property that was anywhere higher than 1%. Which means that those residents kept paying their rent. They care a little bit more about their credit score. They were working in industries that were more stable, and so kept them protected from different, economic crises. And so that's part of why we're shifting our focus towards those Class A's, is especially with cap rates lowering as much as they have, we're able to get our investors the same return with a lot less headache and a lot more stability within that Class A market. And Robert we like to kind of joke back and forth that is COVID over? Nobody really knows whenever it's supposed to be, and the answer is no, it's not, and it's probably here to stay. The ways that this pandemic has changed the market and people's buying and renting habits, even just the things like mask mandates and the way that people look at disease, it's changed forever. And so I don't think it'll ever really truly be gone. There's not going to be a return back to normalcy. But what you can do is accept the new normal and figure out what you'll do in spite of it, which is part of why we're kind of shifting our focus towards that Class A market. Why we think Class A brings so much stability is that, during COVID, like I mentioned, we experienced almost zero delinquency. Everybody's looking into their crystal ball right now. I have mine. I'm sure that you have yours. People say, oh my gosh, interest rate hikes are coming, which is likely going to happen. People are saying cap rates are going to go up. People are saying that we're headed for the worst recession we've seen since 2008. There's a lot of different possibilities. And so it feels like a very volatile time. But with so much potential volatility on the horizon, that's why we're betting on a more affluent tenant base. The middle class, if in any economic crisis in history, is always the biggest loser. They're the ones that end up suffering the most whenever it comes to economic and financial hardship. So that's why we're looking for the people who are going to be able to pay their rent, even if there is a recession, or have the better odds of coming out of that on top. So in terms of what we look at and what kind of deal products you might see from Rockstar, we have two different target models that we utilize. One of them we call our opportunistic target model. The other one is called our Core Plus, and I'll talk about that in just a minute. But for as far as our opportunistic target model is concerned, we typically on those target a 2x equity multiple over a 3 to 5 year hold period. So that means over the life cycle of the deal, all inclusive on the returns that you would get on that deal, we want to turn 100,000 into 200,000 or 400,000 into 800,000. We typically, we would refer to these as more of kind of a buy and flip over a much shorter period. And so these types of deals will actually be more B and C type product that has that opportunity to really, purchase it, raise money for the rehab, renovate the deal, and then flip it to another buyer. We still think there's a lot of potential, and sometimes we find opportunity within that space that it's too good to pass up, and we're going to be able to flip it before we ever have to really worry about a longer term hold issue with that tenant base. Our other target model that we use, and that you'll see a little bit more often, is what we call our Core Plus. There, we're targeting Class A assets. They're typically going to be longer holds of about 7 to 10 years. And we target a 3x equity multiple. We're actually seeing on some of these deals that we've been underwriting lately, we're actually feeling more comfortable conservatively projecting closer to a 3.5 or a 4x equity multiple even on these deals, especially whenever it comes to brand new construction lease up product. But with that said, we target about 5 to 7% annual cash flow, and then we target a refinance within 3 to 5 years, which what that means for investors is what we typically try to do is we'll purchase a deal with some short-term debt that might have a 3 to 5 year IO period, and IO stands for interest only. That means that when we buy the deal and we leverage it using bank or institutional debt, we'll be able to, for the first period that we own the deal, the first couple of years, pay interest only and not pay principal on the deal, because we're not concerned with actually paying the deal down. We want to keep the same amount of leverage that we have. And banks, we colloquially say that they're the best partner in the world because all they care about is earning their specific spread. Whenever they give you a loan, they calculate that we're going to make this much in interest, and then you're going to eventually sell the deal and pay the loan off. But what we want is the income that they make. And a bank's income is interest. So if we tell them, hey, let us just pay interest, we won't pay any principal down, then that works great for them. Whenever the interest only period ends, though, and we start having to pay principal on that note, that directly affects our investor cash flow. So we'll look to refinance out of that loan and into a more long-term debt solution. What we're able to do, though, is because of how the deal is leveraged in those 3 to 5 years, we're focused on driving the deal's value upwards, meaning that, hopefully by the time we refinance, the deal will be worth 20 to 30% more. But whenever you couple that with the leverage that we have on the deal, our goal with those refinance events is to reach 100% return back to investors within that 3 to 5 year time frame by the time we've completed a refinance. And that our goal with that, more than anything, is to mitigate the risk that you have in this investment. Because, and we want to be very transparent about this, just like any investment, you run the risk of losing whatever it is that you put in. If one of our deals goes under, our investors will lose their money. They're not, responsible for anything beyond what they initially invested. But if we start losing investor money, then we're going to have a really hard time finding new investors. And that's one of the, the chips that we have on our shoulder, is that we've never lost investor money in any of our deals. And we've never had to do a cash call to go back to our investors and say, hey, we need you to reinvest more money in order to make this work. Those are both kind of poison pills for any, multifamily operator or single family flipper. Really any lead that you can invest with. Those are two very important questions to ask them is, have you ever lost investor money? And have you ever had to do a cash call? And if they say yes, ask them what happened and for the story on why that happened and if it's ever happened again. Those are both very important questions to ask as you're vetting somebody who you're going to be trusting your money with. So we have this story about investor X who we talk about. We kind of give him a code name because we don't want to necessarily share his private financial information with everybody, but we've gotten permission to do that as long as we don't use his name. But he was one of Robert's first investors, and he started back in 2010 when Robert bought his first deal before we'd actually started Rockstar Capital proper. You see, he's in that Water Chase deal bought in 2010, which is the one that's approaching a 9.7x equity multiple whenever we sell it later this year. But his story was he had all of his retirement funds in a 401k, and he had a family friend who was his stockbroker. When the market crashed, he lost almost everything that he had in his 401k, and had, I think, roughly $160,000 left. And so he had met Robert through a real estate club. He decided he was going to move his 401k, what he had left in it, into a self-directed IRA. And then he invested $100,000 of that into Water Chase Apartments. And through the refinances at Water Chase and through the quarterly cash flow that he was paid out, he was then able to take the 60 that he had left and invest that, make that another 100, invested in Northlake Manor. And then once both of those deals were cash flowing, it kind of started this snowball effect, especially because when you're investing through an IRA, a self-directed IRA, typically you're not able to access that money because it's treated like a retirement account. You can't withdraw anything from it, but you're also able to defer your taxes. So the government isn't getting their piece of your pie yet, but you're able to take 100% of what you just earned and put it back into another deal. And so that kind of helped facilitate such rapid growth. And so he was able to continue reinvesting and reinvesting to the point where now he's in over, I think he's done over 14 deals with us. 12 of those are still active. He now has a total of 1.4 million invested in Rockstar Capital alone. And I know he invests with other leads as well. And he's also been distributed 1.6. So he was received more than he's put in. But he still has 12 deals that are still active. And the biggest return that investors get on our deals is whenever we sell them on the back end. And so he still has those larger paydays coming, which I'm sure he's really excited about. But that's kind of an example, especially using a self-directed IRA, of how that can kind of facilitate that snowball effect. The hardest thing to do in investing in multifamily or even single family or fix and flips, whatever it may be, is getting that first investment, the amount of capital that you need to make that first investment. But, you know, being able to start the clock as early as possible is really advantageous, even whenever you're at a point where you've lost almost everything you had. That he's done really well for himself, just being smart about who he invests with, and also betting on a stable, a stable investment product. So in terms of how you can qualify, and this doesn't even just apply to Rockstar Capital, this is for most multifamily leads out there. You're typically going to want to know two things: what their minimum investment is and whether or not you're accredited. For Rockstar, our typical minimum is anywhere from $50,000 to $100,000. You'll find, especially if there's a much lower barrier to entry whenever it comes to single family fix and flips. There's some leads will have a $250,000 minimum, but everybody does their deals a little bit differently. And then knowing whether you're accredited or not is really important. Just because it lets you know whether or not the SEC itself will allow you to participate in a deal or let a lead allow you to participate in a deal. Accreditation essentially means that you meet one of two criteria. The first one is about yearly income, which essentially means you make at least $200,000 each year and have done so for the last 2 years if you're an individual, or if you're married, that would be $300,000 joint income with your spouse. The other accreditation criteria is having a net worth of at least $1 million. And that does exclude your primary residence, but does include some kind of unorthodox things like a cash out policy on your life insurance. If you think you might be close to that $1 million net worth metric, we highly recommend you engage a CPA or financial advisor to help dive through that with you. You would be surprised how many of our investors don't think that they're accredited, but once they start looking into it, they realize that it does all add up, and they had a lot more in net worth than they initially thought. But that'll let you know, if you see an opportunity online with another lead that says, it's a 506C accredited only, you'll know whether or not you're able to participate in it. But and with Rockstar specifically, we try to have opportunities for both types of investors to be able to invest. Because if you're not quite at that net worth metric yet, that's okay. A lot of our investors weren't either whenever we got started, and Robert certainly wasn't whenever he started Rockstar Capital even. But a great way to build and grow your net worth is to invest in real estate and have that snowball effect, that appreciation over time, so that, hopefully one deal turns into two, and those two turn into four, and so on and so forth. So I'm going to give you guys a quick kind of case study that's just going to show you a really tangible way that we actually create value and valuation at our properties. This slide, you don't have to memorize everything on it. The biggest thing that's important is the unit count at this particular property. It was one of the refinances that we completed in 2020, but it was called Westwood Village. It has 272 units. When we refinanced it, we were able to return $5.85 million back to our investors. And this doesn't necessarily matter as much when you're investing through an IRA because you're already tax deferred, but those refinance taxes, or those refinance proceeds, since we're technically returning loan dollars to our investors, those are actually tax-free events that the government doesn't get to take their piece of. So The way that we make money, and remember, keep that 272 number in your head, is what we call the magic formula, which is that every dollar of income that you make at a property, not just income, but your net income. So we call it NOI. It's net operating income, and that's just your income minus your expenses. Whatever's left over is your NOI. Divided by your cap rate, which is a metric that, for people who aren't familiar, it essentially is how someone determines what kind of return they should be able to get whenever they buy an income producing real estate asset. Because you have to keep in mind, you could have two properties built right next to each other, say, two houses built exactly the same way, built at exactly the same time. Physically, they are identical. But if one house is leased and has a tenant that's actually paying their rent, and one house is still on the market and doesn't have any renters, it's not making any income, then the house that's leased is worth more, because when you buy that, you're going to be able to make more money from it. So that's kind of a long-winded explanation for that. But at a 6% cap rate, which now we're seeing even closer to 4-5% cap rates, every dollar, when you divide it by that 6% cap rate, is actually worth closer to $17. And so there's this multiplier effect for everything that we do at the property. Every dollar that we can raise the NOI by is not just worth that dollar, it's worth 17, or at a 4% cap rate, $25. So our leasing agents and our staff really understand the value of their own efforts at the property. Whenever a $10 rent bump is actually worth $250 in valuation to the property, then the leasing agent will go and chase that extra income a little bit more. So with that in mind, this is one of the example of, a value add strategy that we'll utilize at our properties. Let's say we find a property that doesn't have washers and dryers in the unit yet. Typically, we can charge anywhere from $35 to $50 in the monthly rent. We can bump the rent by that much whenever we have washers and dryers in the units already. The alternative would be to not have washers and dryers in there, and then our residents either have to go buy their own or they rent them from a third party, and that's income that's going to the third party and not to us. And so we want to really help optimize this. So if you do the math on that, especially at Westwood Village, there were 272 units, like we mentioned. So if you multiply $35 by 272, you get the amount of monthly income you've created. Then you take that metric, multiply it by 12 months to get your yearly income that you've created. And then whenever you divide that by a 6% cap rate, just by adding a new program or amenity at the property that raises monthly rent by $35, you've created almost $2 million in valuation. And so that, combined with the leverage that we use whenever we buy deals using investor equity, and then the bulk of it with bank debt, we're able to give our investors a really significant return on these refinance events and these dispositions. An example of what that looks like is we don't just do washers and dryers. There are things like administrative fees, covered parking, valet trash, even expense reduction, because that affects NOI as well, like low flow toilets, high efficiency lighting, CapEx completion and efficiency. In 4 years of owning Westwood Village, we were able to raise its valuation by over $10.6 million. And we were able to refinance it and return 5.8 to our investors directly, which we're really, really proud of. But we've done that 14 times in the 11 years that we've been in business. We have at least 2 refinances that we're looking at completing later this year. And just kind of shows you the power. It doesn't seem like it makes sense. It doesn't seem like it should be real. But when you understand how properties are evaluated and how you can optimize them, it really becomes a very simple task of just trying to raise your income and minimize your expenses. It really is that simple. And so to kind of give you an example of what 2 of our recent deals have looked like, we have Cedar Ridge, which was our refinance that we actually completed in December of last year. We were able to return $7.2 million to our investors. we actually were able to get a lower interest rate whenever we refinanced it, which improved the debt service monthly by $7,400 each month, which is money that goes directly back into our investors' pockets. And then one of our recent dispositions, which was Northlake Manor, we sold last year. That one hit a 9.15x equity multiple over about a 10-year time frame. That deal actually has a really fun story because prior to us purchasing it, it had been foreclosed on twice. Nobody wanted that deal, but we came in, we knew that we could operate it, that we could turn it around, that it was more about the way that the property was run than the property itself. Nothing was wrong with the building. It was just, it had never had ownership that cared enough to try to make something out of it. So whenever we sell Water Chase next year or later this year, that'll actually be the second time that we've had a deal return over 9x to its investors. I wish every single deal could be that way. Typically, we still project somewhere between a 2 and a 4x equity multiple on our deals because we want to stay conservative. But if there's opportunity to overperform, we absolutely will. We don't want there to be a limit on what we try to chase for our investors in those terms. So to give you an example deal of what Rockstar is chasing right now, this is Ascend at Lakeview. We actually finished raising equity for this deal last week, but it'll give you kind of an idea of what kind of product we're looking at and why we like that product so much. This was a beautiful 2021 construction deal. It actually started leasing in November of last year, and we're going to be taking it over at about 60% occupied. Buying it at such low occupancy whenever it isn't even full yet creates a lot of opportunity, and I'll kind of tell you why in just a second. So what we loved about this deal was it was located in the 8th fastest growing county in the US, which is Fort Bend. And since 2000, Fort Bend has almost tripled in population, especially as Katy is starting to run out of room to grow out west. We think that some of that expansion is going to be hitting down south towards Richmond, right off of West Park Tollway. And so we want to be poised to capitalize on that growth. You can see it in the amount of new builds, new shopping centers that are going up in that area. We think it's going to become a very hot spot for new builds and for migration. There's also been a 23.7% increase in rental rates in that submarket over the last 12 months, which is just a monster increase. It shows you that demand is increasing significantly, and demand is increasing faster than supply can keep up with it, which is part of why they built this property in that area. It's actually the richest county in Texas. The average and median household income within a 1-mile radius of this property is over $100,000, which whenever you think about it practically, when we buy or are leasing a property to a potential resident, typically we require them to make at least 3 times the monthly rent before taxes in order to lease at the property. That means that we could significantly raise the income of this property and still have qualified tenants willing to lease it because they can afford those higher rental rates, and their rates are being pushed that way by the market and the lack of supply to meet that kind of demand. It also has incredible amenities at it. The builder built a dog spa in the leasing office so that people who take their pets on a walk near the lakeside can then come in and clean them off without having to take them into their unit and getting their unit dirty. But also, if there's carpet in the unit or we don't want them damaging that. It's a really smart amenity that you don't see very often. And there are a lot of things like that. They actually have a mini putting course at the property. Some very unique, but also highly affluent amenities there that are also driving a different kind of tenant base to the property. And probably what we like the most is that the Fort Bend County Tax Office is a lot more, I'll say that the tax appraiser there carries a much smaller stick than the one in Harris County. We've seen some crazy, ridiculous property tax increases in Houston, which we will always go to litigation on if we don't feel that they're a fair representation of the property's actual value. And we've done so year after year. We have a wonderful tax attorney who goes to bat for us every year. But Fort Bend County's been a county where our properties that we have located there haven't had to go into that fight nearly as much. And so it's an added, it's a much less stress whenever it comes to actually operating this property and trying to hit the returns that we're projecting to investors. We bought this deal directly from the builder, who kind of, to give you the difference in business plan, the builder's job is to build the property and get heads and beds, and then sell it to whoever will buy it. They're not focused on maximizing NOI, because whenever they build it, they already have a price in mind for what that property should be worth. And whenever the property is not stabilized yet and not fully occupied, we purchase it using an assumption called a stabilized cap rate. That means we're not given like a real true cap rate, because the property doesn't have the historical financials to justify that. But buying it at such a low occupancy also gives us a discounted rate on that property, gives us a lot of meat on the bone. For example, they're focused on getting the property leased up, not maximizing its income. So they're concessioning anywhere from 4 to 8 weeks free rent for every new lease that's signed. That means people are getting at least 1, maybe 2 months free whenever they sign on. But that directly affects the property's income, which affects its valuation, which affects its return to investors. But the builder just wants to sell it for the price that they had in mind. When we purchase the property at that discounted stabilized cap rate, we're able to end concessions, start leasing the property for what it's actually worth. And that's part of what gets us to that 4x equity multiple assumption that we're making. We're trying to return 4x over the life cycle of the deal. And we really feel that there's enough meat on the bone there. There are things like homeowners association fees that the property is paying for the residents instead of billing it back to them. They have reserved parking that they're not charging for. They're not doing valet trash, things of that nature, that when you take each of those 30 or 40 or $20 increases and you put those against 4% cap rate, it's actually worth quite a bit in valuation. And there's a lot of opportunity there for us to be able to take advantage of. And then, our operations team, led by a gentleman named Bill Nye, who's not the science guy, but he is a fantastic operator who's done a lot to really raise the pedigree and the experience and the rigidity of our team. He's done 21 individual lease ups across his career, which gets us really excited. We think we're going to be able to stabilize this property pretty early on in its life cycle. So with that said, that kind of brings me to the end of the presentation, kind of telling you who Rockstar is, what we buy, how we make our investors money, and then why we're focused on Class A's. I know, I think I'm about right on time. I know that y'all were wanting to do some kind of Q&A section, so I'm more than happy to answer any questions that you guys might have. And thanks for listening to me ramble for 45 minutes.
Thank you, Jonathan. Yeah, so there are a couple questions in here. First one, or actually the first two by Jay, are going to be, what is the impact of recession on Class A assets, and how did Class A assets perform in 2008 relative to other classes?
Yeah, so Class A as a whole showed a lot more rigidity, even in 2008. It kind of also depends on where you're building or buying a Class A as well. It hasn't always been kind to us. A great example is our worst deal that we've ever done, which I say worst. We still didn't lose investor money and we were able to provide a return, but it just didn't hit the pro forma that we were looking for. But that was actually a Class A property located in the Heights or Midtown. And it was about 86 units. And we learned very quickly that we need to put a strong focus when we're buying a property at who the resident base is and where they're employed. So, whenever we purchased that property, oil was around $100 a barrel. And about 6 months after purchasing it, oil had dipped down to $30. A lot of our tenants were employed right next to the oil and gas company whose office was very close to that property. A lot of them lost their jobs and then couldn't pay rent. And so, Class A is by no means immune to market downturns. But, if you can really dive into the rent roll at a property that you're looking to purchase, make sure that there's either a tenant base that's employed in a very stable market, or a tenant base that is diverse enough that no single downturn is going to affect it significantly. A couple of the deals that we bought in the last 12 months were actually in the med center, because we love deals that are near hospitals or people working in the medical field, because that is historically really stable. People always need healthcare. And so especially with COVID, those deals have done really well. I'm sure everybody has heard, how much travel nurses can make, and sort of the influx in demand for nurses and people in that industry.
Absolutely. All right. So next question is going to be, at what cap rates are you buying properties?
So I would say, Ascend at Lakeview, the property I was just talking about, we are purchasing at a stabilized 4.65 cap rate. The deal we bought before that was around a 3.8. And I think we've gone as low as a 3.5, but it really kind of depends also on the asset class. We bought 2 Class C deals that were a package deal back in January. That I believe we bought both of those for closer to a 6.4. So it's kind of all over the place depending on the asset class, the submarket that it's in, and how well that deal is performing. There are a lot of people who might think, buying a deal at a 3.5 cap sounds crazy. But those deals were actually those med center deals that I was just talking about, where they have this awesome expansion project going on in the med center called TMC3. It's supposed to bring an influx of about 23,000 jobs into that area. And that's an area that's historically really hard to build in. In fact, across the state of Texas, I believe it's ranked the 5th lowest in terms of new product coming onto the market. So with that much new demand flooding that market, it really justifies wanting to buy a property now to be able to ride that wave once that project finishes up and those jobs come to the area. We're going to be doing, we believe we'll be doing really well with those particular properties. So we're not scared to buy something at a pretty low cap rate. But obviously, especially with the Class C product that was, closer to a 6.4, the idea is to optimize them so much that the cap rate comes down and you're able to get a much more significant return on that property.
Yeah. So the next question is from Jay again. It says, how do rising rates impact cap rate and thus the valuation in core plus strategy, since the core plus gains are reliant on appreciation?
Yeah. So it kind of depends. Rising rates don't necessarily directly affect cap rates, and we're actually seeing maybe the first couple rate hikes happening right now, and they haven't affected our cap rates just yet. Really, I would say most deals that we're looking at, we're not going to just completely rely on natural appreciation. So like those med center deals, it's really nice that there's that much new demand coming into the area, and that should cause the property to appreciate over time. But we're also looking for areas of forced appreciation. Things like opportunity to add washers and dryers, to build carports at Ascend, which is a brand new Class A asset, but the builder wasn't focused on income optimization. So there's still ways that we can force new income. The other thing is, when rates rise, typically so do rental rates as well. And so there's a little bit of a symbiotic relationship there where, if our interest rates go up, which makes us pay more on the debt leverage side, then we're typically able to balance that out with higher rents, because as rates go up, less people will typically be buying homes and looking to rent more, which raises demand for that kind of product.
Awesome. So next question we have goes from Michael, and says, do we have the option to choose what property to invest in?
Yes, absolutely. So we do our deals one at a time, which means, we will we'll present to you a specific property that we want to invest in. We'll tell you what the business plan is for that property specifically. You'll be able to dive into our financial pro forma to see all of our assumptions, like where we think income will be in 8 years, what we think we're going to sell it at in terms of a cap rate, the debt that we're expecting on the deal. That will all be specific to one property. We'll raise the equity for that property and then pass it off to our operations team to go and execute the business plan and make sure that everything's on track. then we'll start underwriting, trying to find the next deal. But you'll always, at least with us, be able to know, what you are investing in and where your money's going specifically. So you can kind of pick and choose. We'll have investors who like one deal more than another. So they'll say, hey, I might pass on this one and I'll invest in the next one. Or some people who, will say, they'll be repeat investors investing in each deal. But we've kind of played around with the idea of doing like a blind raise fund. We found that our investors in particular, really, it's important to them to know where their money's going. So we want to have that transparency, but also that certainty that they get knowing exactly what their money's going towards.
Absolutely. Yeah, I can definitely see why, especially when, when they're investing this much. Because like you said, that initial hump that you have to get over is always the biggest one. It's the hardest one to overcome. So I imagine when you're making that kind of investment, they're wanting to know exactly where their money's going.
Yeah, absolutely.
Yep. So that's it for questions for you guys. If you have any other, throw them in the chat now. There are a couple questions for us. Just talking about UDFI, guys. We'd love to take a deep dive into UDFI, but just time constraints kind of wouldn't allow us. Give us a call on Monday. We'd be happy to sit down with you, have a consultation to address any concerns with UDFI regarding your IRA that you'd have. But that is going to be it, Jonathan. Appreciate you for coming out. As always, we love kind of partnering with you guys. Anytime you guys can present for us.
Yeah, happy to do it. And if any of the people watching, you wake up in a cold sweat at 3 a.m. tonight, wondering why you didn't ask a certain question, you can either give us a call on Monday at the number that's on that slide, or you can email us at investing@rockstar-capital.com. Me or Ryan or Robert will be more than happy to help you guys out. We're always looking to help people create, that generational wealth, and doing so whether it's through a self-directed IRA or some other kind of investment. And whether it's with us or anybody else, we're more than happy to help educate you as much as we can.
Absolutely. Thank you so much, Jonathan. And guys, remember, you have 7 days left until tax filing deadline, until our promo ends. Right now, if you give us a call, we can open up a free account for you. We'd be happy to sit down on how you can take advantage of those funds in your retirement to invest in deals like Jonathan talked about today. So thank you so much, Jonathan. You have a good one.
Thank you so much. Good to have you.